We usually just worry about our own taxes, right? But what if I told you that sometimes you could be on the hook for someone else's? It's true. Today, we're diving deep into this fascinating legal idea, the chain of responsibility, to figure out who ends up paying when the person who's supposed to just can't. So here's the big question, right? What actually happens when the person who owes tax, well, can't pay? And this isn't some rare thing. It can happen to anyone, a person, a business, even someone living overseas. So does the tax bill just poof, vanish? Yeah, not a chance. The law has a very clear plan for this. And that plan revolves around this really important legal concept, the representative. The easiest way to think about it is like a financial stand-in. This is a person, or maybe even an entity, who is legally designated to, step into the taxpayer's shoes and take care of business. And believe me, the law is crystal clear on this. A representative isn't just some helpful friend. No, they are treated as if the income was actually their own when it comes to getting assessed and paying up. This is a super serious legal responsibility. Okay, so what does that actually mean in the real world? It pretty much breaks down into three key duties. First, they have to take on all the same responsibilities the original person had. Second, and this is a big one, the tax assessment is made out in their name. And third, as far as the law is concerned, they are now the official taxpayer, or assessee. All right, let's bring this down from the abstract legal stuff to something a bit more personal, because this is where you can really see it in action, in situations that involve families, guardians, and people who are just trying to manage someone else's finances. And the law doesn't mess around. It's super specific about who fits this description. We're talking about a guardian for a minor, or for someone who's mentally incapacitated. It could be a receiver or a manager appointed by a court, or maybe a trustee who's in charge of a formal trust or a WAF. If you're in one of these roles, boom, you automatically have the responsibility of a tax representative. Okay, let's shift gears now and scale this whole thing up to the world of business, where, let's be honest, the stakes are usually a lot higher. This chain of responsibility doesn't stop at the personal level, it goes right into the boardroom. When it comes to partnerships, you've really got two main situations to watch out for. First, if just one partner can't pay their share of the tax, the entire firm can be held responsible. Yikes. And what if the business shuts down or dissolves? Well, then every single partner becomes jointly and severally liable, and you absolutely need to understand what that means. It means the tax authorities can go after any one of the partners for the entire tax debt, no matter what their original stake was. That's a huge deal. Things get interesting with private companies, because the responsibility can split between the directors and the liquidators. Directors, they can find themselves personally on the hook for the company's unpaid taxes, but there's a catch. It's only after the business has been closed for 3 years. Now, liquidators are a different story. They can become personally liable if they screw up during the winding down process. Things like forgetting to tell the tax authorities or distributing assets before they've set aside money for the tax bill. But here's a really important detail for directors. It's not an automatic thing. It's not like you're guaranteed to pay. The law actually gives you an out, a sort of escape hatch. If a director can prove that the company couldn't pay its taxes and it wasn't their fault, that it wasn't because of their own gross neglect or misfeasance or a breach of their duties, then they can get off the hook. All right, so we've talked about people and businesses inside the country. But what about when the taxpayer isn't even here? This creates a really fascinating puzzle, right? How on earth do you tax someone who isn't physically there to tax? Well, the solution is actually pretty clever. The law creates a taxable presence by appointing an agent who is in the country. This person or company in Bangladesh then becomes the official representative for that non-resident, effectively pulling them into the local tax net. So, who can get tagged as an agent? The list is pretty broad. It could be an employee in Bangladesh. It could be anyone with a business connection, someone who's just holding money for the non-resident, or even the person who handles the income they get from here. Heck, even if you just bought a capital asset from them in Bangladesh, you could be considered their agent. Basically, any real financial link can be enough. But to make sure this whole thing is fair, there's a really critical safeguard in place. You can't just be declared an agent out of nowhere. Before that happens, you have to be given a chance to have your say, to be heard by the Deputy Commissioner of Taxes. That's a key protection. Okay, let's finish up by looking at the final links in this chain of responsibility. some really specific rules made just for international transport. This is a perfect example of how the law creates a simplified system to deal with the tricky nature of industries like shipping and aviation. So for shipping companies that aren't based here, the process is super straightforward. Before a ship is even allowed to leave the port, the ship's master has to file a return covering all the income from freight and passengers. The tax authority figures out the total, calculates the tax, and, this is the crucial part, the ship gets zero clearance to leave until that tax bill is paid in full. And what's the tax rate for that? It's a simple, flat 8% of all that income. No complicated brackets or deductions, just a clean, straightforward percentage on the money they made on that trip. Now, if you compare that to air transport, you'll see a similar idea, but with some big differences. For one, the tax rate is a lot lower, and the filing schedule is completely different. Airlines don't have to file before every single flight, can you imagine? Instead, they file their returns quarterly. And that rate for the airlines? It's a flat 3% of their income. And that difference, from 8% for shipping down to 3% for air, probably just reflects how different the business models are for these two industries. Now, the most important thing to remember for both shipping and air transport is that this is a one-and-done deal. This special tax payment is the final liability. It's the end of the line. They don't file other returns for this income, and they can't ask for a refund later. It's just a clean, simple, self-contained process. And this brings us right back to where we started. After all this talk about who's liable, you might be wondering, what about the poor representative who has to pay? Well, this quote from the law itself is the answer. It says, flat out, that they have the right to get back every penny they paid from the person they were paying on behalf of. And that right there is the most crucial point of all this. The system isn't meant to just dump the tax burden on someone new forever. It's all about liability and recovery. The representative is basically a guarantor for the government, making sure the tax gets paid. But the ultimate bill? That always goes back to the original taxpayer. So, when you look at the whole picture, it's clear that tax responsibility isn't always just a personal thing. It's a chain that can loop in guardians, business partners, company directors, even agents. It kind of makes you wonder, doesn't it? Who's the representative in your world? And maybe, just maybe, are you a representative for someone else? And